US Treasury rates are skyrocketing. Bond prices are plunging. What does it all mean? We're going to be talking to Jeff Snider about that, the head of global research at Alhambra Partners. I'm going to read the first sentence of a recent blog post of his, and here it is. If you're fortunate to be able to do this long enough, you're absolutely assured to get caught with your pants down, and almost certainly more than once. Jeff, that reminds me when I first moved to Hollywood trying to be the next Ryan Seacrest, it was hard making ends meet. So what I would do is I would go dance at some private parties, some private residences. And I was wondering, is that what you were writing about here as well?
Well, I'm glad that you had that experience because it sounds like it made you the well-rounded individual that you are, Emil. But no, that is not what I was mentioning there. Obviously, I doubt there's anybody who wants to say anything like that out of me. So what it really is that any market, any veteran or experienced market observer or trader or anybody else, this happens quite frequently, especially in the short run, because you think you got everything measured, you think you got everything clocked, and then wham, just out of the clear blue, seemingly sometimes, the markets will move not just against you, but decidedly against you. And what I'm talking about specifically here is that for weeks and really months, we've been talking about on the show, and I've been writing constantly about how the fact that bond markets in particular seem to be completely, utterly ignoring Jay Powell and Christopher Waller and Rosen and all these other Fed officials who were more and more confident and adamant that they're going to taper their QE, which was supposed to have provoked some 2013 style bond route sell-off reaction. But as again, up until last week, it didn't seem to, the market didn't seem to care much, if at all. And then all of a sudden, that day that we were talking last week on Friday, I believe it was, maybe it was Thursday, suddenly bond yields spiked, and now they're substantially higher than they were. The 10 years about 15 or 16 basis points off of that low that week. And it seems like, okay, have we reached finally the taper tantrum? After ignoring Powell and all this taper talk for so long, our market's finally starting to act very 2013-ish, getting with the program.
It seems like a delayed fuse, a hell of a long delayed fuse for the taper tantrum to take off, but to spark. But maybe, okay, you actually pinpoint a particular moment when this rally, or is it, rally in yields, thus bond prices falling down, may have started. And you point to a Fed governor. Now, this is a Fed governor, not to be confused with a president such as Dallas Fed President Robert Kaplan, who has recently resigned for reasons, or Boston Fed President Eric Rosengren, who also recently resigned for reasons.
The same reasons.
Yeah. We're going to be talking about Mr. Christopher Waller, Governor, August 2nd, CNBC. What happened? Was it him?
Go early, go fast. He wanted to create a new slogan, which was, he was so thrilled about progress in the labor market, the recent payroll reports up before the last one in August, these almost million job or payroll increases in July and June, thinking that, boy, if the labor market continues along at this pace, not only are we going to have to taper, we're going to have to taper real fast so that we can clear the calendar out to get to the rate hikes, because we need to slow this sucker down. This economy is getting way, way, way too overheated if things continue as they are. So on August 2nd, Mr. Waller goes on CNBC, says, go early, go fast. And again, the bond market said, okay, whatever. However, a couple of days after that, on August 4, the 10-year Treasury and the 30-year Treasury, and I believe the 5-year and some of the other parts of the curve, they bottomed out on August 4th, and then yields have slowly started to rise ever since then.
I want the audience we're going to show some graphs, but I want the audience to go to Alhambra Investments and the blog post and find this article, which is titled, Finally the Taper Tantrum, or What's Wrong with August? And it was posted on the 24th of September, because I want people to see these graphs, which are revelatory. Jeff, in previous episodes, we have compared this reflation, the post-COVID reflation, to other reflations, globally synchronized growth, global growth, green shoots. to get a sense of bond markets saying, yes, we are going to explore the upside, and how much enthusiasm they have in, let's get rid of these safe assets, US Treasury, let's get rid of them because the future is so optimistic. So we've done that before. You did something similar, and I don't know how you came up with this idea. Was it just your memory? But you said, you know what? I remember that bond yields rose also in 2020 at this similar time period. And you started comparing this summer to last summer. I'm going to pull up a graph now.
Yeah, so August 4th of this year, bond yields have been gently rising until the last week or so. They picked up a little bit. And August 4th really should ring a bell with anybody who's watching these things closely, because not just August 4th of 2020, but also, or 2021, but August 4th of 2020 had been the low in yields last year too. So right away, we have some sort of coincidence here where starting in early August and coincidentally the same exact day, bond yields have risen. Now already we're thinking, okay, maybe this is just random coincidence, but either way, there was no taper talk or rate hike talk in August of 2020. So if we're trying to assign a taper tantrum to the action in yields in 2021, then it has to be something completely different than August of 2020, even though the patterns here are strikingly similar. So maybe we should go back a little bit further in time and see whether or not there's something common seasonality wise, that maybe it's not taper in 2021, maybe something repeats each and every August. So it's something beyond just the current year or even the last couple of years. So that was really, having done this a long time and having closely watched these bond markets, the answer was, it wasn't like this was a question. This is, you never ask a question you don't already know the answer to. And the answer is yes, this is a repeating phenomenon that isn't just the last couple of years, but it is weird how, and probably just random coincidence, how in 2020 and 2021, yields bottomed out on exactly the same day, August 4th. And maybe there is some kind of fractal behavior that can explain that. I don't know for sure, but that leads us to think, okay, so there's something going on here that's a repeating pattern that is occurring in not just the last couple of years.
Yes, it's probably a coincidence, August 4th, 2 years in a row, or it's simply the limits of human knowledge, and we can't possibly understand how this complex system and the fractal nature of it is functioning with such incredible symmetry. But like you said, you went back even one more year to 2019, and that bottom, there was a bottom in yields that year as well, August 28th, 2019. That's 3 years in a row.
What are the chances, right? I mean, that's, once or twice is a coincidence or randomness, three times is, we're starting to see a pattern emerge here. And remember 2019 specifically, 2019 was globally synchronized downturn becoming recession. August of 2019, the 2-year, 10-year calendar spread in the yield curve inverted. Everybody was paying it. Recession signals everywhere. Things were going wrong. Remember September 2019, the repo rumble. So why is it that yields were rising from August of 2019 forward in the same way they would rise in August of 2021 or 20 forward, and then again this year? So now we have somewhat contrary signals. We have taper in 2021, meaning good things. The economy is doing really well. Yields rise. We have in 2019 heading toward a recession, things looking really dark and bad. The Fed cutting rates, yet yields rise. And in 2020, in the middle, which was after the recession, but before any kind of recovery, yet again, yields were rising post-August of that year. We're seeing a pattern emerge here.
Patterns. Once is a coincidence. You just started saying something, a very well-known phrase that I'm going to read from this book by Ian Fleming, Goldfinger. Publisher's Folio Society. I highly recommend it to anyone who's into books to get their books from Folio Society, which makes beautiful works of art. Chapter 14, Jeff. And it's, guess what? Bonds. Goldfinger. He said, Mr. Bond, they have a saying in Chicago. Once is happenstance, twice is coincidence. The third time, it's enemy action. It goes on from there, and he tells Oddjob to take Bonds to the pressure room. Jeff, do you know? So Ian Fleming, great
So
writer.
James Bond was going to be compressed like a calendar spread sort of thing. Yeah, that's my terrible Bond jokes.
You know what he
I'll leave
did,
the
though?
comedy to you.
No, that's good comedy. Only an economist would love that sort of joke. Jeff, Fleming didn't continue. He didn't say, and a fourth time is this, and a fifth time is this. Why? Because that would be absurd, because once, twice, thrice, things only happen that far. Jeff, is truth stranger than fiction? Do we
Always.
see this pattern?
Exactly. That's why we love reality TV, right? Because truth is stranger than fiction and more interesting. And we don't have to suspend our disbelief because it's right in front of our very eyes. And wouldn't you know it? In 2018, same sort of pattern. It was interrupted, of course, with one key difference, but yet we have this late summer bottom in yields, or at least some sideways that sort of led to a rise in yields again through September and October. But the difference in 2018 was the landmine, which took yields rapidly lower again before the end of that calendar year. So 2018 too, you get to the August and you start to see post-August rise in yields. Again, 2018, more like maybe 2021 in that, Fed was rate hikes, the economy was supposed to be really good. So that modest rise in yields seemed to be consistent with at least what the Fed was doing, in sharp contrast to 2019 and 2020. So we have different cases of the Fed doing different things and the economy believed to be doing different things, yet the same sort of behavior in yields, especially September and October.
And you say in your note here, in your blog post, that you see something similar in 2015 and 2016. Incredible.
A little bit less so, but 2017 is probably the better example because bond yields bottomed out then, I believe, September 5th. So not August, but close enough to August. And then they started this gentle rise post-September, which was consistent with then quantitative tightening as well as globally synchronized growth. So again, the repeating pattern, no matter what the kind of condition or perception of the current state of affairs, as well as whatever the Federal Reserve is doing, either tightening, loosening, whatever in between, 5 years in a row, September and October, in some instances, 4 of the 5 instances, also November and December, where bond yields finished the year on a gentle slope upward.
Jeff, when we were on Nick Black's show, let me get this show correctly because I always mix it up. Crypto and Coffee. I always think coffee and crypto. Nick Black, Crypto and Coffee. You can find him on YouTube and all manner of places on Twitter. I said, what I think is happening right now is that the COVID case counts are peaking and therefore things are relatively better. And so we're experiencing a reflation. But your work here suggests that I'm just applying a narrative that's convenient because this pattern's always happening, right? So maybe what I was saying is crazy.
It doesn't have to be mutually exclusive either. We can have this underlying seasonal pattern, which works out to be, let's be honest, it works out to be a little bit more optimism, right? The bond market looks at September and October, and no matter what's going on anywhere, yields start to rise, which means a little bit more growth and inflation expectations than had been previously during the summer and late spring. So we get a little bit more optimistic each September and October, and maybe it's for different reasons. Maybe this year it really is because the Delta COVID case counts are declining. It doesn't seem to be as nefarious and bad as it once did, maybe a couple months ago. And maybe we will get through this unscathed. So, it doesn't have to be an either or here. We could have this underlying seasonality coupled with idiosyncratic factors each calendar year. But the net result seems to be exactly the same time and again, despite whatever perceptions are going on at the time. So that to me says the underlying seasonality that has to be taking place must be something deeper, more fundamental than whatever it is that comes along each and every year.
Don't worry, Jeff, I'm going to come back to you, but I'm just telling the audience that in part 2, we're going to talk about why this is happening according to the audience, because last week you sent out a tweet saying, hey, everyone, this is what I'm looking at. I'm seeing this seasonality in August. Why do you think it's happening? So I've got a list of everyone's responses. We're going to go over them. By the way, you can find Jeff on Twitter at Jeff Snider _AIP. But before we go there and to close out this episode, Jeff, why don't you give us an idea? What is your theory why we're seeing this incredible pattern repeated summer after summer after summer.
Well, there's two main ideas I have here. In this episode, I want to do the technical one, and we'll talk about the other one, which I think is an even stronger explanation in the next episode when we get to talk about more than just August. But there is something called the globally systemically important bank, right? GSIB, global systemically important banks. Now, global systemically important banks are something that came out of Dodd-Frank, and then we're further expanded around the rest of the world through Basel III, which was essentially looking at the financial crisis in 2008 the exact wrong way and thinking the problem was bad banking. Therefore, we have to put the lockdown on these large banks because, well, all we know of the crisis is that several of the largest ones failed, and that imperiled everybody else's financial condition. So we're going to identify globally systemically important banks, or global systemic, whatever the hell a GSIB is. We're going to identify them, and we're going to make them hold additional capital against their assets to make sure that they are actually sound institutions instead of pretend sound institutions, even though capital ratios that we had come up under all the way up through Basel 2.5 didn't seem to matter a damn bit. So we're going to put some surcharges on these banks because we have to. And the way these surcharges works is there's a couple different ways. Globally, banks are required to calculate their scores under method 1, which breaks down their balance sheet into 5 different categories. I have them written down. It's size, interconnectedness, substitutability, complexity, and my favorite, cross-jurisdictional activity, because that gets into the reality of the monetary world. Now, for U.S. banks, there's 8 GSIBs in the U.S. They substitute for substitutability a weighted short-term wholesale funding score, which is interesting if you're thinking about these things. Now, what happens is in 2016, these rules were adopted in the United States, and the Federal Reserve implemented its method 2 for GSIB scores, which took into account these wholesale funding techniques. And what that meant was, going forward, every bank had to, when they filed their FRY15s, which used to be an annual report on their balance sheet, which has since become quarterly, when they filed their calendar year-end FRY15s, they have to take into account all of these 5 factors and calculate their GSIB scores, which means during the fourth quarter of every year, banks are keenly aware that their activities in the fourth quarter of every year are going to affect their GSIB score and then potentially trigger the SLR, which can actually have material impacts on the amount of capital, therefore a drag upon efficiency on balance sheet, their balance sheet mechanics. So in the fourth quarter, what the Federal Reserve itself has found is that banks get your shock face ready. They manipulate their balance sheets to make sure that in the fourth quarter, they look very different so that they're window dressed in just the right way at the year end. And one of the primary ways that they have done this is through their derivative book, believe it or not. They use compression trading to lower their gross notional book count, which affects their, I believe that's under the complexity score for the Basel. It also affects their wholesale score under method 2, which means they're intentionally shrinking their derivative books in order to end up in whichever score bucket they want to. And this has been established as having taken place, especially in 2017, 2018, 2019, 2020, not yet 2021. So the 4 years where we see the strong rise in bond yields corresponds with the same 4 years in which banks are significantly manipulating their gross notionals in their derivative books, which means they are not only window dressing, they're actually pulling back on their dealer activities. And that was really the impetus behind this one particular Federal Reserve notice, which was, hey, are banks actually in the fourth quarter of every year sort of tightening up their dealer activities, leaving the system high and dry in order to manipulate their GSIB scores? And where that would come into play in terms of rising bond yields during the fourth quarter, you have less derivatives, you have less need for collateral. Therefore, especially since most of these derivatives that are being compressed are interest rate swaps. So less interest rate swaps, which many are collateralized, less need for collateral. This may be a technical reason why during the fourth quarter, bond yields seem to rise regardless of perceptions of economy markets or the Federal Reserve. It's simply banks trying to manipulate and game their GSIB numbers so as to come up with whatever surcharge they feel most comfortable with. And the fact that they're doing this in a way that even the Federal Reserve has picked up on and noticed tells you that it's probably a substantial enough, it's having a substantial enough impact that it could explain part of what's going on in bond yields, as well as, I think more intriguingly, why time and again, think back to January of 2018, the system is left high and dry in the fourth quarter of 2017 because of this GSIB stuff. And all of a sudden, we don't have much for reflation. In fact, we have dollar tightening kicked off from that point forward. So this might not just explain the rise in yields in a technical matter late in each year, but it also might explain why in some periods in the start of the following year, it tends to be really bad. In some cases, significantly bad, so it becomes a more of a systemic problem moving forward. So that's, I don't want to say that this is exactly what's going on or this explains everything. And a lot of what I'm doing here is speculating and trying to draw what I think are reasonable conclusions. But there's a couple things that are absolutely happening. One of them is window dressing, compression in dealer derivatives, therefore lowering the need for collateral. And I think that does happen to tie together, especially 2017, 18, 19, and 20, and likely 2021, because these rules really came into effect in 2016 and weren't more complete. They were phased in 2017 and 2018, but they really started to have a bigger impact in 2017.
Jeff, the BIS puts together a summary of derivative activities of 12 global money centers, as well as estimates for like some 30 different jurisdictions. And they report this twice a year, and it's always like 6 months behind. I don't happen to have the very latest data, but I'm going to pull up a graph that goes through partially through 2020. And Jeff, would you be surprised to see that globally, look at that sawtooth pattern. Look at when it plunges down, the total value. December, lower, huge fall. December, lower again, right? And it keeps repeating every year. December is always lower. I have it through June 2020. I didn't update it lately because I was getting a massage or a tan. I was very busy. But
you were practicing your dance moves.
Yes, I got to make ends meet, Jeff. So there it is. It's in the data. We can see it, I think.
All right. And it's a shame that the BIS doesn't do quarterly data or even monthly data, but you can understand why they don't, because as we've said repeatedly, this is not an area that's very well studied. It's not an area that's very, very well monitored. And so the data just doesn't exist. And some of the data you have to wonder, how accurate it is anyway, because banks are notorious, not just window dressing at year ends or quarter ends, but they can window dress at any time they want, which is why we're in this particular episode, we're focusing on the entire fourth quarter, because that seems to be when all this compression trading activity takes place, which can seem to have, and if you're one of these banks that are doing this window dressing activity, you don't want to wait till the last minute to do it. You're going to take your entire fourth quarter to make sure all your ducks in a row so that you're not caught at the last minute with something you can't anticipate. So that's why you would expect that this to happen over these particular months.
All right, part 2, we're going to delve in deeper and broader. We're going to expand our view, and as well as listener requests and suggestions. We're going to hear what the people think may be explaining this pattern.